Hello there. Welcome back. We are now going to discuss another one of our tax mitigation solutions. Again, we got Ryan Tansom on with us. Appreciate Ryan being here. Again, Ryan is from Independence by Design. He's the my technology guru. We've had a few issues this morning, and so he's helped me out. So I appreciate Ryan's patience with me. Independence by Design is a business ownership course that Ryan teaches and helps his clients create an ownership framework to maximize the value of their businesses. So Ryan is he's done over 402 podcasts and is not only a good friend, but my technology specialist as well.
And yours truly has been on the podcast, so I appreciate it, Roger. It's fun.
I've been on the podcast, you're right. So the next strategy we're going to talk about today is the close haul capital. This is one of our leveraged charitable gifting strategies. Again, within our, just to kind of remind everybody, within our framework of tax mitigation solutions, we have our business deductions, our business creation. Leveraged charitable donations is the category we're talking about today with close haul capital. So this program is a leveraged cash donation. Essentially, we're able to finance a charitable gift. Basically, we're going to be borrowing money to give away. Sounds interesting, right? So the nice thing is it's a more efficient way to be charitably minded, increase the value of your cash donation, of your own cash, because you're going to be using OPM, other people's money, right? Because we're borrowing via secured loan, and it requires a one-time prepayment of interest and an assignment of some collateral. So we're going to walk through how that works, but the initial payment is in year one, and there'll be no further payments. So let's talk about how this program works. The ideal candidate is essentially anyone with a gross AGI of over $300,000. And the nice thing about leveraged charitable gifting, we've talked about this in the past, is that because you're donating to a 501c3 and it's a personal deduction, I really don't care what type of income you have, whether it's business income, W-2 income, or even capital gains income. Okay, we can use this for all three types of income because it's a below the line deduction. That's the beauty of these leveraged cash donations or leveraged charitable gifting in general, is it will offset not only W-2, but also business and even qualified plan distributions. Okay, so very powerful. And if you don't understand how the IRS works with charitable gifting, essentially the government incentivizes certain behaviors, and you giving money away is a certain behavior they like to incentivize. So they allow us to deduct the value of our donation on a one-to-one basis. You get to reduce your taxable income by the amount of your donation. Okay. So limitations with this program, a little different from the other ones we've talked about. We're able to write off 60% of your adjusted gross income. For example, if you have an AGI of $1 million, we can take a $600,000 deduction, which would generate a new AGI of $400,000. Okay. So what is a charitable investment fund? Because that's who we're going to be borrowing money from. Okay. A charitable investment fund is a charitable investment organization that has created a fund of multiple donors. So essentially, big picture, a bunch of wealthy individuals have come together. They've created a fund that they donate to. They get a charitable deduction for the money they put in, and then they get to live off the interest that's generated from this big pool of money. They get to live off the interest, but part of the requirement is the interest that they're making off of this big pool of money. Portion of that interest must go to their charitable intent. Okay, so in this case, we've created this big pool of money. The charitable cause is to help others be charitable. Interesting concept, right? So they've created this bucket of money, and their intent is to use some of their interest earnings to help others donate to other 501c3s. Okay. In 2024, there's about $100 million available that close call has available for us to tap into to be able to borrow from that money to then give away.
So Roger, quick question on that. That $100 million came from the investment stream that they saved up, that became the fund that then can be borrowed against?
So the fund was created by, let's just say there's $1 billion sitting in the fund.
Mm-hmm.
That $1 billion is kicking off interest
Mm-hmm.
to the participants. $100 million of that interest earning each year is what they're going to be lending out to participants.
Got it.
As the fund increases, so does the lending power of the fund. So it's a 4-step process. Step 1 is Ryan comes to me and says, Roger, I've got $1 million of W-2 income. What do I do? Again, W-2 income is always one of the more challenging types of income to offset. We say, okay, let's look at a close haul. First step is we're going to create a little revocable grantor trust. That trust is then going to be, there's going to be assets that Ryan owns. He's going to pledge to the trust. So just a little bit of a accounting practice here, education. Pledging an asset is different than funding an asset. So if Ryan has a house or an investment account or other asset that he wants to pledge to the trust, he does that via a pledge agreement. Okay, it's just a piece of paper saying I pledge this asset to the trust, which is different than I'm going to change the ownership of my asset to the trust. That's called funding.
Any different than like a personal guarantee, Roger?
It's essentially a lot very simpler, but that's very similar to a personal guarantee, saying I'm going to pledge this asset to the trust. I'm not going to fund it, but I'm going to pledge it. Right?
And is that also one of the main reasons it's probably got to be a revocable trust and an irrevocable trust?
Exactly, because we can pull the asset in and out, unpledge the asset, pledge new assets, and so forth. Right.
Got it.
So we can pledge public stock, real estate, business valuation, other assets that you may own. Right. As a pledge agreement into the trust, the amount of the asset that you pledge is going to be the amount that you borrow from the trust or from close haul capital. Okay. So how this works is there's a great big pool of money, $100 million, let's just say. And you, Ryan, are going to have your trust borrow $600,000 from close haul capital.
From their $100 million fund.
From their $100 million fund.
Got it.
They create a loan. It's a promissory note. Your trust receives the $600,000. That $600,000 will then go to close haul charitable. Okay, that's the charity where the $600,000 goes to the charity, and you receive in return a receipt saying this trust donated $600,000. One, the beneficiary, and because it's a disregarded entity, that deduction will flow down to your personal tax return.
Mm-hmm.
Okay, so now we've created a promissory note between. So here's just the sample. We've already kind of showed how that would work. If you were at $1 million, your effective tax rate, depending on what state you're in and so forth, let's just say it's $300,000 to be conservative. Okay. Well, if you take $600,000 and wipe that out as a deduction, that's going to leave you with $400,000 of taxable income left, which will be taxed at about 80%. Or sorry, $80,000 left of tax liability. So you're taking your tax liability from 300 down to 80. Does that make sense?
Mm-hmm.
Okay. So you're going to save about $220,000 in taxes. So what is it going to cost you to do that? Okay. Well, first we're going to create a little trust. Okay. The processing fee for the trust to get that set up is a one-time $2,500. Okay. There's going to be a 1% of your gifted amount as an administration fee. And they're going to require, as part of the promissory note, a prepayment of between 30 to 36 months of interest, okay, on that $600,000. Okay. The interest is going to be based on AFR rates. You borrow $600,000 at AFR rates. Well, currently the AFR rates are 4%. Cool thing is, as interest rates drop, close haul will redo the note and lock in that lower amount. If interest rates increase, they're going to keep it at the current AFR rate, right? So they wouldn't increase the rates, but you have the opportunity to have a lower rate. Again, you're borrowing money from a charity. The charity really doesn't want to charge you interest. They just have to create the promissory note.
Economic substance is what I always continue to hear from you, right?
That's a great statement. So again, scenario one, you have $1 million of taxable income, pay about $300,000 in tax. In your situation, Ryan, you're in Minneapolis, you're paying a little bit more than
I was going
$300,000.
to say that 30% is not looking bad.
If you're in Texas, maybe we're closer because there's no state tax, right? But if it's in scenario two, we're going to have $1 million of taxable income. We're going to borrow $600,000. We're going to write that $600,000 off. You have $400,000 left and an estimated tax liability of about $80,000 after your gift. Okay. So the prepaid interest in this scenario was about $66,000. So you allocated $66,000 towards your promissory note. You paid a few fees. So let's just say that the fees were about $8,500. So total you put in $72,500. Okay.
Mm-hmm.
Which saved you $220,000 in taxes. So between your total tax that's left and the fees, you have $154,000, which means you saved $154,000 net of the fees and the payment of interest. Okay. Well, now what do we do with the $154,000, Ryan? I say this on all my calls just to make sure everyone understands. Whenever I help you mitigate your tax liability, that $154,000 in savings isn't money we're going to go buy a fancier boat or a nicer car, right? We're going to put that money to work, right? Because that $154,000 is really going to be the difference of maximizing your legacy. So if you take the average stock market over the last 50 years, let's say it's 10.5%. Depending on who you're talking to, it can be higher than that or lower than that, but it's funny how averages actually work, right? So if you take $155,000 and invest it over the next 40 years, well, you're going to have about $10 million more in your legacy than if you had just paid the tax. Does that make sense?
Yeah, and this whole philosophy and mindset is very similar to just the pension approach when they were invented years and decades ago, which is take it out before you get the take home, and then it's kind of after, out of sight, out of mind, and then you should be fine or more than fine.
Well, we just want to make sure the money goes somewhere where it's working, right? So now what happens? So you borrowed the $600,000, you get this nice big tax deduction, you save $154,000, you invest that money and it starts growing, right? Well, now let's talk about the legacy piece, because the promissory note does not require any more payments for the rest of the life of the structure or the rest of your life. So because you have no payments for the next 40 years, there's no more costs. But what's going to happen is that in 40 years or when you pass away, that promissory note is going to come due to close all capital. Well, if you've taken your $154,000 and you've been growing it all that time, right? So think of it that way. Now, there's another way to pay off the loan, which is via life insurance, and we can talk about that as well. But option one is just use the money that you've been saving all these years to pay off the loan as part of your estate planning, right? Or you could create a little permanent life insurance policy with some of the tax savings that you've experienced, the $154,000, and buy a guaranteed universal life policy that has enough death benefit to make sure that your trust has enough money to pay off the charity when you pass away. Okay, but if we just look at the math this way, if you invest $155,000, you're going to have about $4.3 million if it makes 8.5% over the next 40 years. Okay. Well, over that same time frame, the estimated loan balance would be your $600,000 plus your accumulating AFR rates, right? Which would be about $1.3 million, right? So you've taken your $155,000, you've turned it into 4.5 because of your investing. You're going to use 1.3 of that to pay off close haul capital, okay, or your heirs are, because you're going to be dead. So then close haul. The cool thing about all of this is this strategy is a way for you to benefit from your charitable giving that you're going to do when you die, but you get a benefit this year because you're going to borrow the $600,000 that eventually you're going to end up giving away, but you get that deduction this year. Okay. Well, what happens is if your trust pays off that loan, Close Hall is going to take 75% of the loan proceeds, or what you paid back. They're going to turn around and give that to whoever you want as your charitable contribution. So again, you're giving money away in the future, but you're getting the deduction now. Because if they get the 123, they would end up giving 975,000 of that back to a charity of your choice. So you are going to net $3.2 million over the life, let's just say it's 40 years. You would net an increase of $3.2 million that goes into your legacy. Plus, your charity is going to pick up $975,000 because of what you pay back to the Close Hall. And that 75% is going to end up in a charity of your choice. So, as part of the structure, we're going to list which charity you would like the funds to actually end up at. So, one little thing, if you follow the structure this way, you have enough money in your estate to pay off the loan, and then your family still gets $3.2 million. Everything's great, right? Or if you choose option B, you could create a life insurance policy with some of these tax savings that has a $1.3 million death benefit, so that when you pass away, your trust would have the cash needed to pay off Close Hall Capital. Okay. So that's the two ways you can pay off the loan. The cleanest way is just to have a life insurance policy that makes sure there's cash there, where the trust is the beneficiary of that life insurance policy. That's the way I prefer to do it. But you could use your estate could use the cash from your estate to pay off the loan. And then that money ends up going to the charity that you want to go to anyway. So again, it's a way to be, if you're charitably inclined, this is an excellent way to benefit now for your charitable gifting when you pass away. Okay. So basically, we're going to increase the power of your donation dollar, right? We're going to reduce your tax liability. You're getting about 1 to 9 deductions, somewhere there, 1 to 8.5, 1 to 9, somewhere in that range, as far as your cash outlay required to get this deduction. And you are setting yourself up for an awesome legacy play. Because you're creating a legacy, right? You're going to be leaving money to whatever it is, your family foundation, to your church, to whatever you want to leave that money to. It's an awesome way to be able to do that.
Well, and Roger, I want to insert a comment there too, where like when I think about people's decisions, whether it's, working in their W-2 job or business owners who are looking to reinvest and they're trying to hit a specific valuation, that timeline changes and the dollar amount that they're trying to hit changes if their estate planning desires are met outside of their current work, labor, or company. It just allows them more opportunities and more freedom to be able to say, okay, what's the timeline and how do I want to currently manage my current situation if I've got the legacy play, accelerated or taken care of.
I like it. It's just having that peace of mind that at least you're going to be leaving something for your legacy, right? So as far as compliance goes, what you're going to receive is a Schedule A tax deduction. You'll receive a receipt for that goes on your 1040, goes on line 11, cash. It's a cash gift. That receipt comes from the charity, Close Hall Charitable. And because it's a password entity, there's no 1099 and there's no asset assignment. You're pledging the asset that is required. Okay. This is what the receipt will look like. In case anyone really wants to see exactly what the receipt will look like, take a quick picture of that if you'd like. And basically, all we need to know is how much your adjusted gross income is. We're going to take that number, and you'll be able to borrow as much as 60% of your adjusted gross income. Again, we are going to account for other charitable gifting that you're doing. So your total cash charitable gifting is 60%. We'll send you out the intake form. It says, okay, give us your information. Once we receive that intake form, we'll basically send that off to Close Hall. Close Hall will send you the invoicing, send you the lending service agreement, create the trust, and take care of the trust and the tax documents for the rest of the life of the structure. And again, there's no additional cost for that. That's all going to be included in the initial formation. That's where the $66,000 and the formation of the trust, that's all taken care of at the beginning. So there's no additional capital outlay for the life of the structure. If you have any questions, here's my information. Again, this is a structure that it's not new. It's been around. This particular we call it pooled income fund has been around for about 12 to 13 years. We've been working with the promoter, Close Hall Capital, for a couple of years now. They've done lots of this structure, and every year there's a little bit more cash to be able to lend out to the participants. And it is a little more complicated than the other charitable gifting structures, but it's also a little more powerful. So that's a choice you get to make. Do I have a little more complexity, I get a lot bigger deduction, or do I use one of the other structures that we'll do another series on as far as the other charitable gifting structures that are available? So thanks, Ryan. Thanks for being here, giving me something to talk to. And again, if anyone has any questions on this program, we're happy to help. Thanks a lot.